Welcome everyone to our master class on student loans. Thank you very much for joining me today. Unlike the courses you took in college, this class will save you money rather than cost you tuition. Also, if I can stop myself from going off on tangents and rambling incoherently, then this class should be less than a half hour long instead of an entire semester, which is what we're hoping for. Now, by the time you graduate from this class, you'll have learned some proven tactics for cutting your monthly student loan payments and possibly even getting some of your balance forgiven. Now, what are the prerequisites for taking this class? Just two. You're burdened by big student loans and you're willing to take a few minutes to get your financial life back on track. Now, I'm your professor today. My name is James Matthews. I've been through most of this myself, but for the past few years, I've been helping countless others like yourself navigate every possible student loan situation you can think of. I work with Consolidated Credit, one of the nation's largest and oldest nonprofit credit counseling agencies. We have an A+ rating with the Better Business Bureau, and for the past 26 years, we've helped over 5 million Americans get back on the path to financial freedom. Drawing on all that experience, we launched Coffee, which is short for Knowledge of Financial Education. It's our employee-focused collection of online self-help resources matched with live financial coaching and counseling. Now, the mission of Consolidated Credit and Coffee are one and the same: to assist families throughout the United States in ending financial crisis and solving money management problems through education and professional counseling. Now, how do we do that? In three ways. That is, financial education and wellness, debt management services, and housing counseling. Now, first, our educational offerings include everything from interactive lessons to online calculators to old-fashioned handbooks. Whatever way you want to learn about your money, we offer it. You can even call to speak to a certified credit counselor. Second, our debt management services help you pay down your debts much quicker than if you tried to do it on your own. For example, our debt management plan can reduce your monthly credit card payments anywhere from 30 to 50%. And third, we offer specialized counseling for what's likely to be the most expensive item you'll ever buy, a home. The home buying process can be very complex, but our experts can help you navigate it. So if you need any help in that area, just give us a call. But today, we're not here to talk about credit cards and mortgages. We're here to talk about student loans, which is a form of debt. It fits neatly between both of those. In other words, mortgages are still the largest form of debt in the country, but coming in at number 2 is student loan debt. At more than $1.2 trillion for everyone in this country, that's more than all the credit card debt that this country owes, which is still over $1 trillion. Unbelievable, just crazy. But, you know, for such a big problem, there's not a lot of talk about big solutions. Not enough, at least. But first, let's review just how big this problem is. Maybe you've heard it called the student loan crisis. You know, you may be thinking that's a little melodramatic, but it's accurate. According to Time magazine, more than 40 million Americans are carrying big student loan balances, and of those, nearly 6 million owe more than $50,000. And that's according to the Brookings Institution. And CNBC reports 1 million of them defaulted on their loans in 2016 alone. Now, that's almost 5% of all borrowers. That is not a good ratio at all. But, okay, so the student loan crisis is so serious, it's become a national political issue, and I'm not here to get political. That's not my place, but believe it or not, both parties agree on this, even in this hyper-partisan era. Newsweek quoted U.S. House Representative Alexandria Ocasio-Cortez, who said, "Student loan crisis means my entire generation is delaying or foregoing purchasing houses." Fox News' Tucker Carlson said, "Congress must address the student loan debt problem and stop colleges from scamming our kids." Bold words from two very influential people. Of course, they each propose different solutions, but until there's bipartisan support for legislation, nothing will change, so don't count on it. But it's not as doom and gloom as it sounds, since there are already many options available to you. I'm going to go ahead and start discussing those now. Now, forbearance. This is a concept that's familiar to anyone who has called their credit card company and begged to get a late fee removed. Yes, sometimes just asking works. Your servicer wants you to keep making payments, so sometimes they'll give you a forbearance, which means you can temporarily stop repaying your student loans. Basically, it's like a hold button for our loan payments. Now, you may ask, why doesn't everyone simply do this forever? Well, it's not that simple. The thing is, you need a darn good reason for such incredible debt relief. These so-called discretionary forbearances require your service's permission. So if you can't make your payments due to a change in jobs, a medical expense, or other financial difficulties, your servicer can decide to give you a forbearance. Then there's mandatory forbearance, which means your servicer can't deny you the forbearance if you qualify. Well, what's it take to qualify? Well, here is just a few examples. If you're on a medical internship or a residency program, if you're in the National Guard and got activated by the governor, or if the payment is more than 20% of your monthly gross income. I'll repeat that. If your payment is more than 20% of your monthly gross income. I repeated it because it's important. You can be approved for a mandatory forbearance if this applies to you. But there's plenty of other scenarios. You need to spend a few minutes conducting your own research and plugging in your own particular circumstances. The few minutes you spend might save you thousands of dollars, so it is absolutely worth it. So whatever forbearance you qualify for, you can get up to 12 months of making no payments. In total, you can get 3 rounds of 12-month forbearances before you max out. That gives you plenty of time to get your financial life in order. It should, but remember, you still owe the loan amount. And in fact, under a forbearance, your interest charges continue to accrue. Because you're not making payments, that means your overall loan debt increases. You don't pay it for 3 years, 12 months, however long it takes. Interest charges are going to get you. So you get some relief now, but later on you're going to pay for it. Of course, the rules are different for private student loans because the rules are always different for those, which we'll discuss later. But still, anything is better than defaulting on your student loans, which is what happens when you don't make payments for 270 days or more. That means your wages can be garnished, your credit score is trashed, and any future tax refunds and other federal benefits can be withheld. You don't want to go down that road. It's not a place you want to be. But let's talk about deferments now. As you can already see, student loan jargon can get very particular and difficult. In this instance, a forbearance and a deferment are more similar than different. In fact, the only major difference is that with a deferment, you might not owe that accrual of interest we just talked about. But like a forbearance, you must have some pretty serious circumstances that prevent you from making these monthly payments, like, say, a cancer treatment or a job layoff. It needs to be something serious. Now, this is just a rough overview of forbearances and deferments. You want to know how detailed it can get? Here's a quote from the Federal Student Aid website, which I will read to you and you will understand it completely. You may be eligible for a deferment on your federal student loan if you are a parent who received a Direct Plus loan or a Field Plus loan while the student for whom you obtained the loan is enrolled at least half-time at an eligible college or career school, and for an additional 6 months after the student ceases to be enrolled at least half-time. Now, that's very clear, straightforward, right? No, not very. You probably have to read that 6 times over before you understand what it means. But don't worry. By the time we're done with this, I'm going to show you a path out of this wilderness. Just trust me on this one. But okay, let's talk about the government. The federal government, that is. It offers a myriad of programs to help you cope with your student loan debt. The first is called the Income-Based Repayment Program, or IBR. If you have federal loans and can demonstrate a financial hardship, you qualify. Basically, an IBR matches monthly payments to your income. It's the government's way of acknowledging that the salary you earn after you get a degree usually doesn't exactly match the expense you incurred to get it. For example, the program adjusts the monthly payments on your federal direct student loan debt to your income and family size. If you have a lower income and a larger family, it reduces your student loan payment requirement. In general, enrollees spend between 10 to 15% of their take-home income to repay student loans under an IBR. This reduces the burden of student loan repayment on your budget. but the government acknowledges that this can still increase the total cost of the life of your loans. Still, it helps you greatly in the short term, so for some, it could be a very good choice. But just to make these programs a little extra confusing, there's also one called an income contingent repayment plan. The ICR is a little different than the IBR, other than it being one letter off. While both adjust your monthly payments based on your income, the ICR has a few important differences. First, you don't need to show any crushing financial problems to qualify. You just do, you qualify for it. And on the downside, unlike IBR, ICR doesn't stop your monthly payments from increasing indefinitely along with your income. So how do you choose between them? We're going to answer that a little later because we're not even halfway through all of the complex options available to you. So I don't want to jump the gun here. But like I said earlier, once we've gone through all the options, we'll show you an easy way to navigate this convoluted process that we as a society are stuck with. And just to add some gasoline to the fire inside your brain, there's a third federal student loan relief program that matches monthly payments to your income. It's called Pay As You Earn. It's even better than IBR at reducing monthly payments. It was updated and expanded a few years ago into yet another program called Repayee. First one, payee is, pay as you earn, repayee. It's revised pay as you earn. But the concepts are still the same. Your monthly payments are reduced to 10% of your discretionary income, which is discretionary income, and after 20 or 25 years, whatever balance is left is forgiven and forgotten. You pay nothing more. But, that's 20, 25 years. It's a long time. But let's talk about the difference between the two. They're subtle, but they're real. For instance, to qualify for payee, you must have a partial financial hardship. Repayee, anyone with qualifying student loan is eligible. Your spouse's income doesn't count in payee if you file separately, but does in repayee. So what does all this mean? Generally speaking, payee is a better option for married borrowers when both spouses have an income. Repayee is usually better for single borrowers and people who don't qualify for payee. But in both cases, just like an ICR, if you get a new high-paying job or a big fat raise, your payments jump up along with that extra income. If you want to see if payee or repayee is right for you, we once again recommend you visit studentaid.gov. There are so many variables. We could do an entire presentation just on that. So go ahead and go to studentaid.gov and do a little research on your own. So now that you're thoroughly confused, we're going to move on to some other options that are a little more straightforward. Let you take a breather, take all that in, but we're going to start in now. Okay, so if you've ever used a debt consolidation loan to take care of credit card debt problems, you might think you understand how a federal direct consolidation loan works for student debt. But you'd be wrong. You use a federal direct consolidation loan to consolidate federal student loan debt into one easy payment, but the loan structure, interest rate, and how you qualify varies greatly from other types of consolidation loans. Consolidating debt is generally done to simplify debt repayment. If you have multiple individual debts to repay, it can get complicated to juggle all those bills within your own budget. Consolidation reduces that down to just one bill, so debt is easier to manage. However, that's not the only advantage to a federal direct consolidation loan. In this case, taking out this type of loan provides an additional benefit that can be significant depending on your situation. Namely, you can make defaulted federal student loan debt current, which is huge. It's an amazing benefit and one worthy of a few minutes of your research, especially if you've defaulted on federal student loans in the past. Applying is easy. Again, you do it through federal websites like studentloans.gov. That's studentloans.gov this time. And we'll tell you at the end of this class, how to learn more, possibly by hiring an expert to assist you, because it can get complicated and sometimes you want an expert by your side. So Now, if you don't want to deal with forbearances and deferments, and you're not interested in the federal relief programs we just talked about, you do have another option: refinancing your loans on your own. When you refinance, you actually take out a new loan at a lower interest rate. This works best if you're not cash strapped and want to pay off your loans faster. That's because you need a credit score high enough to qualify. Basically, you're consolidating your federal student loans into one private loan for a lower interest rate. You can then use the savings to plow money back into paying off the principal. So you're able to pay it off faster with a lower interest rate. It's great. It's definitely an option you want to consider if you are not cash strapped. Okay, so to do this, to refinance your student loans, here are the first 5 steps that you need to take, starting with the simple step of figuring out how much you want to refinance. Then you need to record the balance and APR on those loans so you can shop for a better deal. But remember, when you apply for a new loan, that results in a hard inquiry on your credit report. That can temporarily drop your score. It's not a huge deal, but it's worth mentioning because if you apply for too many loans in too short a time, you could end up paying more. Let me give you an example. You don't want to refinance your student loans at the same time you apply for a new credit card and are trying to secure a new auto loan. All those hard inquiries at once, not to mention the new credit, could definitely drop your score and raise your rates, so you're actually going to be paying more the interest. Okay, so now we get to the most enticing but most complicated part of this master class on student loans. Now, can you really get your hefty student loan balances forgiven? The answer is yes, but. Now, the Public Service Loan Forgiveness Program, PSLF for short, provides a path to federal student loan forgiveness if you work in a qualified public service profession, and that includes many in the medical profession. The government might forgive a portion of your federal student loans. Now, there is always a but when you feel something is too easy. You know, but turns a great word into something you dread. This but may seem bad, but it's far better than most other options. So the qualification process is long, it's complicated, and worst of all, it is not guaranteed. This option requires you to make 120 qualified payments first. That's 10 years worth. But if you do qualify, you could get out of student loan debt for less than you originally borrowed, which is, great. This one is definitely worth spending some extra time on if you're not sure if you would qualify for it. Take a shot, go do some research, find out if you do, because it will absolutely save you a ton of money in the long run. Remember when we're talking about these federal relief programs like IBR and Repayment and how they lower your monthly payments, matching them to your income and family size? Yeah. Well, we also mentioned that they can cost you more in the long run because they increase the repayment term for up to 25 years. Looking back at the 10 years, 25 years, you definitely want to research to see if you can be eligible for the forgiveness. 25 years, 2.5 decades is a long time to be in debt, so the fact that PSLF forgives your balances after 10 years, it's just a huge advantage. If you qualify, it's quite literally worth the hassle. But here's one of the catches, though. To qualify, you must first enroll in one of those federal relief programs, IBR, ICR, Repay, and you must recertify your income every year to remain eligible. As an aside, you can see why some folks choose to refinance on their own. It's a complicated process, and it doesn't stop until it's paid off or it's forgiven. So finally, you can only take advantage of this program if you work in certain professions that the federal government deems a significant contribution to our society. Luckily, that includes nurses and doctors, but it also includes firefighters, police officers, teachers, and there's a whole separate but similar program for military veterans, which I'm not going to get into. Okay. Sorry, I might have skipped ahead here. I want to make sure I don't do that. While I'm recatching my place, you can go ahead and think about everything I just said, find out what your situation is, and if that's something you need to, if you will qualify, if you are going to qualify for. All right, we're back. As you can see, this stuff can get very complicated. You might need more than just a few seconds to piece it all together in your brains. It's enough to fluster a PhD. It's one of the big reasons that the Government Accountability Office told Congress that 51% of all federal direct loan borrowers were eligible for the IBR program we mentioned earlier. Yet, only 13% actually participated in it. And the Department of Education even admits that their efforts to increase awareness about these federal relief programs is incomplete and inconsistent. That's why you might want to consider hiring a professional. Think of it like your taxes. If your income taxes become too complex, you can hire a CPA or tax preparer who not only saves you the time and aggravation, but can also find ways to save you money. Hopefully more than enough to cover the cost of hiring them in the first place. That's what's been happening in the world, more and more, the world of student loans. Now, in just a moment, I'm going to go ahead and talk about some scams that you're going to need to watch out for. But let's review how to find solid professional help. First, spend a few minutes looking them up online. Have they been doing this for a while? The best firms have at least a few years under their belt. And second, check for online reviews. That includes personal finance websites that field questions from confused or irate customers. There's a lot of insight there. And third, if the firm has an excellent rating from the Better Business Bureau, that's a big plus. Finally, see if these firms are recommended by other sites. Some of those sites actually recommend only those firms that agree to and adhere to a code of ethics. And if you want to learn more about this option, and if you're a busy professional, I recommend exploring it. You can call Coffee's certified credit counselors to learn more. We're here to help you. Okay, so back to the scams. With this much money on the line, some bad actors are bound to come after you. While new scams pop up all the time, we're just going to go over the big ones, which are also, thankfully, the easiest to spot. Let's begin with the advance fee scam. This happens when one of those agencies we talked about insists you pay a small upfront fee. And when I say small, I mean up to $1,000. Unless that money is being held in escrow, you shouldn't pay money first to save later. Legitimate third-party companies don't charge you until they start working for you and getting results. A version of this scam charges you a consolidation fee or a processing fee, administrative fee, whatever it might be, to consolidate all of your federal student loans. The thing is that you can do this on your own for free at studentloans.gov. Now, if you want someone to do this for you, you can certainly pay for the convenience for their service. But if the company doesn't tell you up front about the free do-it-yourself option, then they're not being ethical. Flat out, they're just not being ethical. And finally, last scam I wanted to talk to you about. If lawyers didn't have a bad enough reputation already, there's the law firm scam. Now, a lawyer or someone who says they're a lawyer claims to be able to settle your student loan debt for pennies on the dollar. Sounds great, and all you got to do is send your student loan payment to them instead of your servicer. They'll handle the rest. The law firm is going to go ahead and renegotiate with your servicer and reduce what you owe. Now, except, problem is that law firm never makes a payment. They keep your money, and you go into default because your servicer has not heard from you. In the worst of cases, the law firm even has the audacity to come back and offer to negotiate with your servicer, again, to get you out of default for an additional fee. Anyone want to guess if they actually follow through with that? No, they do not. It's a total scam, and they try and double dip, and it's terrible. But if you take nothing else away from this class on student loans, learn this. Stick to third-party resources who have been around for a while. They have excellent online reviews and have an A+ rating with the Better Business Bureau. It's a clear sign that they are reputable. Okay, so far, almost everything we've discussed has involved federal student loans, and there's a good reason for that. Federal student loans represent around 94% of all student loans. Private loans are only a fraction. Now, what is a private loan? Simple. You go to the bank or other private lender and secure a student loan just like you would an auto loan. Because these go through private financial institutions that face competition, their customer service is often better than some of the horror stories you read about with federal student loan servicers. Then again, you're not eligible for those federal relief programs if you have private student loans. So your options are pretty much to throw yourself on the mercy of your lenders or consolidate your loans like we talked about a few minutes ago. That's also an option. Many Americans with private student loans also have federal loans. They took out the private loans to cover what their federal loans couldn't. So when you call a third-party company to help with your loans, they can offer you some general advice because if I haven't said this before, student loans are a very complicated subject matter. Okay, just some random notes here since we get asked these questions all the time. First, when you apply for forbearances, deferments, or federal relief programs, your credit score is not affected. However, if you try to refinance your loans on your own, your score can be affected. The most common mistake is to apply for multiple refi loans instead of just asking for quotes. Every time you apply, it triggers a hard inquiry, which drops your score a bit. As you can see from this master class, figuring out how you'll save on your student loans often involves knowing exactly what you currently earn and spend. And I realize that giving you advice to create a budget is like telling you to floss your teeth. We all know it's a good idea, but it's boring and tedious and no one wants any part of it. Unfortunately, unchecked spending can be far worse than a toothache and a large dental bill. If only there was an easier way to handle such a painstaking task. Well, imagine if you could have that a robot floss your teeth and keep track of your budget. The second part is actually true because that's exactly how you can budget these days. Online tools like My Money through Life Credit Union make budgeting easy. Your bank or credit union probably offers its own suite of tools. Take advantage of these and tap a few keystrokes to create a budget instead of spending time with pen and paper. You'll be glad you did. And finally, don't let all this daunting information depress or discourage you. This is meant to be educational. It can feel like your head will explode from all the rules and options, but you have help, both free and paid. The bottom line is that the programs and advice we discussed today can greatly enhance your bottom line, help you breathe a little easier. So that's it. You've graduated from our money-saving student loan masterclass, but let's recap a bit on the most important lessons. First, you never want to default on your student loans because your wages could be garnished. They will be garnished. Second, a few minutes of research on your part can save you not only from default, but can also save you thousands of dollars. Third, your options include forbearance, deferment, income-based repayment, income contingent repayment, pay as you earn, federal loan consolidation, refinancing, and in some cases, even loan forgiveness. If you have private student loans, you have fewer options, but you can still get help. The bottom line is, if you can't put in the time to figure out which option is best for you, maybe consult a reputable professional who can save you much more than they'll charge you. Whatever you do, don't do nothing. Take action. All right, so here's your imaginary diploma. Make sure to frame it and hang it somewhere nice. As you take a step back and admire your hard work, remember that working on student loan debt is just one piece of the financial puzzle with which Life Credit Union can help. Financial freedom is an attainable goal, but let's be honest, the path leading there is fraught with peril. Life Credit Union can light the way for you, making it easy to get there quickly and safely. When it comes to the principles of financial education that will help you relieve the burden of student loan debt, it's really hard to cover all the concepts in one webinar, so visit lifecu.org for more helpful information or contact Ann Wires directly at ann@lifecu.org. At Life Credit Union, we're there for you for life. Thanks again for joining me. I hope you leave here feeling a bit more confident that you can achieve your goals. I'm James Matthews with Coffee and Consolidated Credit, and I want to personally urge you to get ahead now and thank yourself later.